So hello, this is the last session for today. I see that the Europeans are just waking up and the Americans are shortly going to fall asleep. So let's get this on the road. So the GCGC program typically includes two panels, and one of them we devote to a topic that is of practical relevance, not to say that any of the papers that were presented are not of practical relevance, but of direct practical relevance. And the topic we've chosen for this year are stewardship codes. Now, you'll know that ECGI has the world's most complete collection of corporate governance codes. Small plug there. Now, we've added to this stewardship codes, which are the sort of new kid on the block. And we wish to explore them this afternoon to see and to hear why we have them, whether we really need them, what we can get out of them, etc., etc. And I have the privilege of having a panel with me where we first of all have Yasumasa Tahara from the Japanese Financial Services Authority, one of your regulators, quite independent, Roberta. He will kick off by telling us about the Japanese stewardship code and putting it in context. We then have with us Guy Jubb, who already introduced himself. So he is formerly with Standard Life Investments in the UK. He's been heavily involved in, I guess, the development of the UK stewardship code as well a bit, and certainly the application. Now, Guy, as one of his third or fourth career hobby, he goes off to advise people on stewardship codes, and as of late he's been to Kazakhstan, I believe, to advise them on their stewardship code. And then, of course, we have our good friend Ron Gilson from Stanford, who's going to make it all more lively. And then we have you, of course. So without much ado, let's get going, and we first have a presentation on the Japanese stewardship code, and then we go on the stage and we keep going. Thank you.
Thank you for your kind introduction. Good afternoon, ladies and gentlemen. I'm Yasumasa Tahara from Japanese Financial Services Agency. It is really my pleasure to speak to you at this colloquy here. I'd like to explain about the stewardship code in Japan. First, its introduction process, then the recent division of the code. As these charts show, it is pointed out that Japanese companies fell behind the rapid changes in the business environment and lost competitiveness over the last 20 years. Thus, the Abe cabinet decided to implement a corporate governance reform and introduced stewardship code and corporate governance code as a part of the growth strategy. As this chart shows, Japan's corporate governance and stewardship codes are expected to work as two wheels of a cart that is work in tandem to increase corporate value of the companies over the long term. As for stewardship code, Japan's code is principle-based and comply or explain approach, which are same as most stewardship code around the world, including the UK code. Japan's code was composed of 7 principles summarized on this slide, and initially there are 21 guidance and principles. Principles of Japan's codes have similarities of those of UK code, but Japan's Principle 7 states that institutional investors should have skills and resources necessary for engagement, which is not stipulated in UK code, because most Japanese investors have not been accustomed to engagement. On the other hand, escalation, which is stipulated in the UK code, is not stipulated in Japan's code, as it was said that escalation in a prescribed manner would not work well in Japan and rather discourage constructive dialogue. Currently, 214 participants signed up for the stewardship code. After the introduction of the stewardship code, it is said that constructive dialogue has increased. However, as the slide shows, There are also concerns over whether institutional investors, especially Japanese investors, implement the stewardship code in an effective manner. So this is why we established a council to monitor the implementation of two codes. After the examination, the council has recommended the revision of the code. So another council which drafted the code originally succeeded the work and finalized its revision on Monday this week. I would like to explain about the major issues of the current stewardship code revision, starting from the revision related to asset owners. Japanese major asset owners on the left-hand side have significant presence in Japan's capital market. However, it is said that Japanese asset owners are not proactive in stewardship activities, and only limited number of them participate in the stewardship code. In order to cope with these concerns, guidance has been added to encourage asset owners to properly instruct asset manager to carry out effective stewardship activities and monitor their activities. As for asset managers, three major issues have been revised. Firstly, conflicts of interest of asset managers. Japanese asset managers often belong to large financial group, left-hand side, or has many business lines in themselves, like right-hand side. It is said that these give rise to conflicts of interest for asset managers. In order to eliminate the influence of such conflicts, guidance has been added to make asset managers to establish governance structures to prevent conflicts of interest and formulate specific policies to mitigate the risk of conflicts. Second issue is index fund. As those chart shows, that index investment has been increasing and dominate about 80% of all equity investment by Japanese public pension funds. It is said that asset managers of those funds are not proactive for stewardship activities. So the revised code states that index funds should conduct engagement activities proactively since they need to hold shares for a long time. Third issue related to asset manager is the quality of engagement. As I said, Principle 7 of the code states that investors should have skills and resources necessary for engagement. The revised guidance further emphasizes the importance of the role of the management of institutional investors. It also asks asset managers to conduct self-evaluation and disclose such results, which will be used by asset owners for their own evaluation. In securing interests of beneficiaries, transparency of stewardship activity is very important. Transparency is also important in mitigating the risks of conflict of interest I mentioned. The current stewardship code stipulates that investors should disclose aggregate voting results. However, as this table shows, there are differences in the level of disclosure by types of asset managers. Thus, the revised code has stipulated that investors should disclose company-level voting results, as mutual funds are obliged in the United States, like right-hand side. Several major asset managers, such as Mitsubishi Trust, Sumitomo Life, and Nomura Asset, and Daiwa Asset, have already declared they will disclose voting results, and some of them have already actually started company-level disclosure. We expect other asset managers will follow. Finally, let me talk about proxy advisors quickly. The influence of proxy advisors have increased noticeably in Japan, as you see the chart. However, it is pointed out that the resources proxy advisors allocate to Japan is not enough, actually very scarce, and their consulting business might cause conflicts of interest. Thus, in the revision, guidance is added to encourage proxy advisors to dedicate sufficient management resources to Japan and disclose their management of conflicts of interest. We hope that the revised code, as shown in this slide, will serve to further improve effective engagement between investors and companies, so that sustainable growth of companies will be realized through improvement of corporate governance. So this is my presentation. Thank you very much for listening.
I think we have the perfect backdrop slide here, which sets it all out. It's complicated, yes. So, Guy, how does this stack up to the UK and other international experience?
Yes, well, thank
your
you, and thank you very much for taking us through what is the process and the changes that have been made. And speaking as a former institutional investor who took a serious interest in stewardship, I'm sure that the Japanese Stewardship Code, combined with the Corporate Governance Code, has improved the relative attractions of Japan as a place for long-term investors to invest. But there is still a degree of skepticism, I have to say, and only today I was reading about, in the Financial Times, about they describe Goldman Sachs as leading a declining herd of bulls in terms of the attractions. But I do recognize that you have laid the foundation which will serve Japan and its investors well. However, there was one thing which I was looking for, but I did not see in the code itself. And this is the fact that in Japan, although there has been a very significant improvement, there is a great bunching of AGMs. It used to be the case that over 90% of AGMs took place on the same day. And that was not conducive for responsible shareholder engagement. But there has been a significant improvement. The last figure I saw was that the number of AGMs on the same day, the good news is that it's down to 30% on the same day. And part of this from a governance point of view is not an ideal situation. But there has to be some incentive to encourage change. The 30% clearly has, through the eyes of a Western investor, declined further. And there has to be some incentive to enable change. But also that incentive, perhaps through the Stewardship Code, it may be that investors themselves should be asking companies to address this. And I'm not convinced that many investors actually are asking that question. They're talking about many other things, but not actually the elephant in the room of that. But broadening the discussion out to stewardship codes more generally in a global environment, there is a challenge now for institutional investors because, as Marco mentioned, there are more and more stewardship codes out there, and there are quite a few in the pipeline. India, for example, SEBI has made a very strong indication, the new chairman of SEBI, that they are going to have a stewardship code. And this presents challenges to institutional investors because, and particularly the large investors, because they are expected to sign up, and they should sign up to the codes. They are comply or explain codes, all largely modeled on the, it's one of the best British exports, I think. They're largely modeled on the UK code. However, as they themselves are called to account for how they behave, it is important that they find an approach to stewardship that is scalable. And if you look to companies, we have mentioned BlackRock several times, Legal & General in the UK, and even my former house, Standard Life Investments, there are thousands of companies in the portfolio which are subject to the stewardship codes, and the nuances of difference, and you've identified some important ones today, for example, about having the skill sets to engage. The distinctions are important distinctions, and the investment houses have to find some thoughtful solutions. Now, some of these solutions could come through use of the proxy advisors in an intelligent way. Some of the use can be used of broadening out the role of stewardship, which has tended, the responsibility for stewardship and the engagement has tended to, in the institutional houses, to focus in teams who have been designated responsibility for doing that. I would suggest that there is a strong case for actually broadening out that responsibility within the investment houses, so that the fund managers and the analysts who have actually probably the best knowledge of the company concerned and what the company is doing, there should be one of the possible solutions is to get the fund managers themselves to not just be making buy and sell decisions, but actually rolling their sleeves up and getting involved in the stewardship discussion as well. Index investors, the growth of index investors also poses some issues in terms as to what the incentive is for them to engage with a view to encouraging performance. Index investors are usually hired with a mandate to perform within a tolerance of the index concerned, and there is not of itself an incentive to encourage the performance of the companies in which they invest. There may be an implied responsibility, but that is not an overt one. The second area which globally it needs some attention, and it's an evolutionary point, is the need for enforcement of stewardship. Japan has taken an important step in its revisions. I would suggest that the next time the revisions come round, they should be, the FSA could and should be giving consideration, maybe must be giving consideration as to how they are distinguishing between those investors who are being good stewards and those who are merely pretending to be good stewards. The way that the FRC in the UK has approached this is that they have identified now and segregated the signatories to the code into 3 tiers. Tier 1 are those who are doing the job properly and get a gold star. Tier 2 are those who are doing sufficient, but in the school report could do better, and they are encouraged to do so. And tier 3 are those who have been named and shamed, and they are vulnerable to go down a grade the next time the review comes round. And I know from my talking to a number of those who have been named and shamed, this is hurting them. They are concerned. Their brand is being damaged. And they are rolling their sleeves up to actually move up the class of stewardship in a way that is important. So, but enforcement is very, very important because this is a public interest issue, stewardship, and regulators themselves have to be the people who play a part. Now, I do know that many regulators will say, well, actually, it's the asset owners, the clients of the institutions, who should be doing that enforcement. I would suggest that they are not the enforcers, they are the overseers and making sure the generality is abided by. But actually, from the public interest point of view, regulators need to be seen to doing something. And finally, in terms of the overall picture on stewardship codes globally, and for the avoidance of doubt, this includes the UK. And I was particularly interested to see that you had included in your code, because I think you are providing a lead here in ensuring or requiring that the investors have the right skill sets. I believe there has to be much more training given by investment houses in the art of stewardship. Stewardship is an art, it's not a science, but it does require particular skill sets. And whilst the specialist teams will go out to conferences and have some awareness of what is going on, I believe that one has to actually embed the skill sets more broadly. It has in investment institutions. It has to be part of their DNA. It has to be part of their values and their culture. And they have to be able to demonstrate as part of their license to invest that actually they do have the skills, but furthermore that they are investing to sustain the skills going forward. So to conclude my comments, I congratulate once again the FSA for taking forward the stewardship code here in Japan to the next level, acknowledging that there are more levels to come. And from a more global perspective, the three messages are scalability by the investing institutions, effective enforcement by regulators, and fit-for-purpose training by the investment houses to enable the stewardship to be delivered for the public interest and the client interest.
Ron.
I'm going to be speaking this afternoon with, it's a bad metaphor, but with two different hats on. One is my normal academic hat. The other is as the independent chair of a moderate-sized asset manager, a role I've played for a number of years. The question I'm going to try to address is what is the problem for which stewardship is the cure? And so, because it's late, I'm going to tell you how the story ends at the outset, which is that if there is an explanation, if I can identify, if one can identify a problem for which stewardship is a cure, it's going to be a local problem. That is, it's going to be key to a particular country, in particular institutions, and particular asset managers. So the notion that we're observing a broad movement of stewardship across radically different countries, I'd offer as evidence that there isn't a general problem yet. So let me make this quickly. What could the problem be? The problem could be that asset managers lack sufficient incentive to monitor in a way that will generate performance. That won't last. That won't work. Because if we look at the economics of running an asset management firm, they're very large economies of scale. They get paid a percentage of the assets under management. What we do know is that assets, particularly for active managers, assets follow performance. If we look at, particularly since the increase in passive investment, over the last 4 or 5 years, essentially all of the positive asset flow into active managers in the United States has gone into the top decile of performance measured over a 3-year period. Every other active manager essentially has been losing assets over this entire period. Now, if you also realize that the scale economies in asset management are enormous, they're kind of lumps, but if the scale economies are enormous, the margin associated with an additional dollar of asset base approaches 100%. So it's a little hard to be incentivized any more intensely than asset managements to perform in order to attract assets. With respect to passive managers, they have no incentive. Because if I take this out 2 years, the general prediction is that the fees that Vanguard and Fidelity will charge for running a passive fund will be 0. They'll make their money on securities lending, so that they will have no real return on increasing the size of their assets, under management. So, at least for active managers, they're enormously incentivized. For passive managers, they have no incentive. Second possible concern, perhaps asset managers can both identify problems in their portfolio companies in a deep way, and then effectively engage with their portfolio companies in actually figuring out how to solve the problem. How do we break the conglomerate up? Where are the lines? Talented portfolio managers may be quite good at identifying what the problem is. They're not going to be any good at all in identifying actually operationally how to solve the problem. I've never run into a portfolio manager who had operational as opposed to investment experience, and they know it. So if the active managers are going to do it, or more importantly, if the passive managers are going to do it, then we got to create the skills in-house. So I've got to put together a group of people who have the capacity to make that analysis and know enough about operating a company in a particular industry that they can actually go out and have something to add to that assessment. Well, where am I going to get those people? How am I going to incentivize them? How am I going to pay them? Do I pay for performance like every other part of the operation? Do I look to see what's happened to the value of that company and the ability and the changes that they've participated in and pay them based on that? We can do that, but remember what we're doing is we're creating an in-house activist. That is, they're engaging in precisely the same behavior as the activists. If we're going to get people who are as good as those people, we're going to have to pay them. And we can do all the training we want, but if we don't start with the talent, and talent is, we're not going to get anywhere, and talent is expensive. And I started by saying I think the answer has to be local. In the context of the United States, we have stewardship. We have stewardship through intermediaries. Asset managers are intermediaries. They're managing their clients' fund, their clients' capital, because they have skills that are more efficient at their level through aggregation than it is operating at the client investing themselves. I suggest to you that the kind of monitoring I'm talking about, where you're actually engaging in identifying the problem and then implementing that, is also an intermediary's role. It's the role that activists play in the United States. They show up with a slide deck of 300 slides and try to persuade portfolio managers who want to be voting the shares in an actively managed fund that their solution will increase the value of the portfolio. And of course, the portfolio managers are paid on performance. And the activists get nowhere unless they can persuade the institutions that this is a good thing. So all we're seeing is a specialization of the stewardship process in the same fashion that we have a specialization of the investment process through intermediaries. Where I end up is that there may be in particular countries with particular institutions, particular distributions of assets. We may be in a second or third best world, and we generate monitoring structures that fit that setting. But then keep in mind the problem that stewardship is designed to respond to are problems with respect to local institutions, local culture, and local incentives, and the argument in favor of broad-scale adoption of stewardship codes seems to me yet to be made seriously.
Mr. Well, maybe you want to go first.
Well, could I maybe
ask you to comment in particular on what's the problem that the UK tried to solve by introducing the UK stewardship to start with, and then maybe we go to the FSA, and you can maybe repeat what's the problem that the FSA is trying to solve with or the perceived problem with the stewardship code.
When Ron, I think, made a number of very, very good observations. However, he used the P word of problem, and you used it, Marco, yourself. I started to count the number of times Ron referred to the problem, but I actually gave up because I just couldn't keep track of the number of times that the word problem was used.
The third word, I think.
And my point, however, is that in terms of being good stewards, and we haven't used the word owners as well within this, that actually stewardship is about having good long-term relations between asset owners and asset managers and the companies in which they invest throughout what's sometimes called the stewardship chain. I've just given a small part of it. And whilst addressing problems may be part of the purpose of a stewardship code, a much more important part of a stewardship code is having effective dialogue between particularly long-term investors and the boards of companies in order that the investors can help to inform the decisions which boards then make on behalf of investors, and that can cover, and you're right to incidentally pinpoint that operational issues, there is investors need to recognize their limitations. However, investors can send strong messages regarding their views on dividend policy, which may be important, or on risk management, as well as dealing with when there are particular issues of problems relating to management performance that need to be addressed. And I used to, Standard Life, by the way, for those who don't know Standard Life Investments, they are one of the UK's largest active fund managers, in sterling terms, some 250 billion, 300 billion under management. And but we were long-term investors, but I rather gave up trying to defend whether or not we were long-term or otherwise, because we weren't forever investors. But I used to say that we were investors, we had a long-term relationship with the companies in which we invested, and that was the hallmark of stewardship for me.
Mr. Tara.
Yeah, thank you for comments. There are so many issues to address, so it's really hard for me where to start. But as I should mention, the corporate governance reform in Japan is really growth-oriented, as I mentioned. And the problem is also corporate governance reform is implemented. Many listed companies are not, implementing them in a substantial way. That's the biggest issue. As you mentioned, still the annual general meetings are concentrated in late June. That's 3 months after the year end. That's fiscal year end in Japan is March. And that really hinder probably the engagement between invested companies and institutional investors. And to change this kind of situation, we really need their engagement by asset owners, asset managers, and as mentioned, whether this stewardship issue is local or more international, probably this might be a very local issue at this moment, and we probably need input from asset owners, and because as for passive fund, there would be big incentive for asset managers to engage with their invested companies, but if GPIF, which is the biggest asset owner in Japan, managing 1 trillion US here. They invest through asset managers, and some of them are through passive fund. And they sort of encourage asset managers to engage with passive index asset managers to engage with their invested companies. So this method might not be generalized in global context, but in Japan, it's working. And as the head of GPIF is nominated the government to sort of secure the interest of beneficiaries, So this is the current situation of incentivizing passive fund managers to engage with their invested companies at this moment. But in the long run, probably the literacy of stewardship code or corporate governance code will grow in Japan, and we are seeing a rapid change. So gradually their level will be globalized, and in 5 years, 10 years, probably most retail and institutional investors are quite conscious about stewardship activities and corporate governance, and that when, probably that's when annual general meeting will disperse around the world, around the year, not only concentrating on the end of June.
Okay, so in the interest of time, I would like to open up to the floor. I'm sure there are many observations on the challenges that we have, that stewardship codes try to address. Katarina.
So, hi. I think I would like to know a little bit more about the political economy of these stewardship codes. It strikes me that if there is no problem to be solved, and we're trying to impose relationships on maybe smaller funds that can't afford to have these relationships, and what we're seeing is basically a way to put the smaller investors on a silver plate for the bigger ones to absorb. It's an anti-competitive move because the others can't afford it. And it very much reminds me of the extension of the Basel capital adequacy rules within the European Union to banks that were not internationally active, which basically put them on the silver plate for all the big Western banks to gobble up. So I'm wondering whether that is a plausible story for why we're seeing this, or would really like to know a little bit more about who's pushing for this particular initiative.
Excuse me, I'm not really a native speaker, so would you speak a little bit slower?
Sorry, yes. So I'm just wondering, especially in the original country in England, how the stewardship code came about. So what I'm suggesting is an alternative story is if there's not a real problem to be solved, and we're telling at the same time that what we want is a particular relationship between some managers and the firms, but not all of these intermediaries out there can afford it, then it strikes me that what could happen is basically an anti-competitive move to push some of the smaller players out of the market. And I'm just wondering whether this is a plausible story.
Guy, do you want to respond to this? Since
as somebody from
the UK was mentioned here.
I think England was mentioned, and as somebody from Scotland, I will. But the stewardship movement was formalized following the banking crisis, and Sir David Walker was commissioned by the UK government to look into the governance and the failings of governance at banks and other financial institutions in the UK. And he wrote a transformational report shortly after as the crisis was moving into history. And what he identified was that the boards of banks and other financial institutions were not effectively accountable, and it is the challenge of accountability which what he was seeking to address through the Stewardship Code. And you mentioned from the legal perspective and the forcing to do things. One of the key points of all the stewardship codes that I am aware of is that they are operating on a comply or explain basis.
But you also talked about shaming.
Yes, well, the point is, though, that there are those who seek to indicate that they are complying, but when put to the test, and this is where, even in Japan with the self-evaluation approach, you need to have an independent check and balance, because if there is an incentive, a commercial incentive, in the UK, and I think it is the case in a number of other countries for investment managers to perform stewardship, is that the asset owners who give the mandates to invest require as a precondition that the investment manager is a signatory to the relevant stewardship code. And that is where the incentive lies, and where the free rider issue, which is another way in part of expressing your point, arises.
To the transparency point, and the Walker Report is a good example. So let's imagine I want to create a stewardship operation within my manager group that has the skills to assess on an ongoing basis the global risk management program of Barclays. My guess is if half of the board had that skill, I'd be happy, but I can begin to think about the dollars it's going to cost me. So one thing we might want to do for our investors is transparently identify the amount that we're spending on this because it's coming out of my investors' pockets. If we want people with the skills that are necessary to deeply both understand the company, understand markets that are moving ever faster, to understand their operational circumstance, we're going to need people who are as talented as the people who run it. That's going to be expensive. So would you then suggest that we amend the stewardship code so that among the disclosures is a certification of the costs associated with the stewardship process? Wouldn't you want to give your investors the same thing?
There's a couple of points there that I would like to rise to. The one, I think it actually would be a very good idea to provide some transparency in aggregate as to how much is expensed in terms of fulfilling the stewardship function, and it's not beyond the wit of a good chartered accountant to be able to do that. And it would be an interesting badge in terms of comply or explain as to exactly quite what was being put into the pot. Interestingly, one thing that is not done for companies is actually what the cost of corporate governance is in companies. And I think actually that would be a very interesting disclosure as well for corporates. Your other points were around, I know about the, where I think I would differ in terms of my understanding of stewardship is that to take the case of Barclays and risk management, the investment managers, the investors, are not the directors of the company. They are holding the directors to account. I talked about the art of stewardship and the training of stewardship. What I learned over my time when I was in the front line was the art of being able to ask the right question and then to be able have the art of understanding. It wasn't actually so much what people said in response, but it was how they said it, the confidence and the conviction. But the art doesn't begin and end with the first question. You have to have that ability and confidence to ask supplementary questions so that at the end of the day, you have reasonable assurance that actually the directors concerned, and here I'm talking about both executive and non-executive directors, are capable and are fulfilling the responsibilities that are entrusted to them. So it is clearly necessary to have some knowledge of the issues. However, there is a line in the sand where responsibility begins.
Wu-Cheng Kim.
Thank you. I have 2 points. One is I just want to update on the Korean Stewardship Code. It was adopted last year in December. And some people have high hopes because National Pension Service, which owns around 6% of the market cap, up until today, they were very passive when it comes to engagement. But with the Stewardship Code, they did indicate they would adopt and they would try to comply as much as possible. This would really change the landscape because they own 6% of the market cap and so on. And in this regard, I have a question for FSA, the gentleman. What does exactly GPIF do to encourage the investment managers to comply the Stewardship Code?
Mr. Tahara.
Yeah, as I mentioned, they have a sort of engagement activity with the asset managers. Yes. So asset manager basically report what they do as engagement with their invested companies, and they actually score their asset managers' activities, and they allocate depending on that sort of score. So if the asset manager would like to get fund from GPIF, they need to follow the actual instruction about engagement. Not the instruction, but they need to properly engage with their invested companies that will be evaluated by GPIF, and GPIF judge whether they are doing engagement, asset managers are doing engagement activities properly or not.
Elizabeth Becht.
To me, the whole debate around stewardship seems to be linked to some extent to the question of whether or not there is a slight shift underway in corporate law from shareholder rights to shareholder obligations, since to me it seems that institutional investors do not really have a right or just the opportunity to opt out of this regime for reputational reasons. And I was wondering what your views are on that.
Any views?
Oh, excuse me. Your question is, which,
No.
yeah.
Yes, please.
I was just wondering whether the debate around stewardship, since institutional investors do not really have to, so they don't seem to have a right to opt out.
They do have right to opt out. This is
right?
comply explain, and adoption is truly voluntary.
Yeah.
Of course, there is a shame approach.
Yeah.
But this is really voluntary, we would say. But if they do not sign up for corporate stewardship code, probably they cannot get funds from GPIF or other big funds. So that works, voluntaries, or it's necessary for them to follow. That's true.
Yeah, that's
in that
right.
sense, you cannot opt out.
Yeah, and it just seems to me that there is a slight shift underway in corporate law, since the concept of stewardship seems to be well established these days. And just for reputational reasons, these institutional investors, they can't afford to not comply in a way, right? So, and it's now an obligation. I mean, in earlier times, it was only the obligation for shareholders to pay for the shares.
But
right?
they do not. If they do not need fund from those big asset owners, they don't need to, accept stewardship code, and they can, just do business with retail investors. That's fine.
Mm-hmm.
And as for even small institutional investors previously mentioned, if they are excelled in stewardship activities, then they can do business with, big funds and by, sort of pushing that kind of specialty.
Thank you.
If I could just say one brief comment. We haven't spoken about the public interest aspects of stewardship, and clearly as a regulator, the FSA is a guardian of that. But I do think that the large institutional investors do also have, and we see it particularly in Europe and a degree elsewhere, about executive compensation and holding boards to account. I do think that there is a public interest obligation on the larger investors over and above their client responsibility.
I'm going to just not let that go entirely unresponded. The phrase public interest requires specification. Now, if my investors are saving for their retirement, in my view, the most significant public interest is making sure they have enough money to do it. And if what you're suggesting is that I want the asset manager, in assessing the way my retirement savings are invested, to make judgments about the asset manager to make judgments about their private conception of the public interest, that strikes me as it's odd, because if I look at who's supposed to be making public policy, and I'll speak only for the United States, the makeup, these are not diverse boards of directors. And the notion that I want to delegate to that group of people the effective power to tax my clients' retirement savings based on their personal view of the public interest seems to me extremely difficult to justify.
Jeff Gordon.
So I want to follow up on Ron's suggestion that stewardship codes need to be evaluated in a local sense, because I think, I mean, the UK story, at least as I have thought of it, perhaps I'm wrong, is not really about Walker, but it's about the Kay Commission. And it's about, because Walker, of course, has been empirically falsified, unfortunately, for Walker, which is to say the banks whose boards were most accountable to the shareholders performed worse in the crisis rather than the reverse. So the governance lessons of the Walker report were, unfortunately, they didn't fit the data. But I thought the stewardship codes really stemmed from the Kay report, which complained about the short-termist pressures of control markets, especially from foreign investors, on UK firms and their ability to supposedly pursue a long-term objective. And so the stewardship codes were an effort to gather the wagons around in a way as to protect, allegedly, the long-term decision-making by managers. Now, in Japan, the situation is quite the reverse, which is to say, the insulation from control market pressures at firms is very high. And so therefore, the stewardship code, if I'm getting your gist, is an effort to try to pursue a second or third best strategy of getting the shareholders to put the kind of pressure that otherwise might be provided by control markets to eliminate slack, to try to encourage investors to perform that monitoring function which the markets are disabled for doing. So this is further to the point that stewardship is essentially a caption, but and maybe the rules are the same, but what's important is the problem, to use a word, as the national issue for which stewardship might be invoked, and it seems to me quite different in the case of Japan on the one hand versus the case in the UK on the other. And I wonder particularly how the FSA might see that.
Yeah, and actually the code really intensifies the long-term mid to long-term view. So basically, the goals, the engagement should be done in long to mid-term perspective. So it's really contrary to short-termism. So in that sense, we think that's very similar to UK code. But at the same time, as more engagement is done by various, investors and various companies, so there is a sort of pressure on companies to think about their capital policy. So our dividend level are getting higher than before. So it might be a sort of short-term consequence, but as stewardship code itself that really promote mid to long-term,
Could I just follow up? What's the short-termist pressure in Japan?
Well, that's like you should pay more dividends.
I'm sorry?
You have enough liquidity, so you should pay dividends.
U.S. hedge funds.
Like U.S. activists, kind of.
Except the number of those engagements is what? You can count on the fingers of two hands?
Oh, two hands means?
They're not very many. And they're well controlled, and they're the outlier.
No, we really encourage, the code encourage institutional investors to discuss about like a corporate vision, corporate strategy, R&D investment, and so on. So the code is really targeted at mid to long-term growth of invested companies.
Well, Jeff, I think the common theme is there's a perception that institutional or asset managers are not doing enough, and the codes are there to put a bit of pressure on them to do more. Now, exactly what that behavior is to be defined, but I think there is a global agreement in Japan, in Europe, and the United States that it's supposed to be this K long-term thing to be defined. But I think that's sort of the consensus amongst these stewardship code writers. That's at least my understanding. Anyway, there's another question from Amir Licht.
So this is a question for Guy and for Mr. Tahara regarding a point that Ron mentioned briefly in his talk. It's about the compensation scheme. Like in your view, you both, what it would be the optimal compensation scheme especially in the light of stewardship code? Should it be like a flat cut, a fixed cut from assets under management, perhaps also from the contribution, or some performance-based payment with all the risks that Ron kind of alluded to?
Thank you. If I understand correctly, it's a compensation for asset managers. Yes. You mean? As it's always there are so many complaints from asset managers because they want to be paid by performance at this moment, and probably in future I think that's true. But probably basically asset managers here are paid based on asset under management, and usually 1% per year for the funds they manage. And initially, they got 3% or 4% from retail investors, but that's much lower for institutional, asset owners, and also it's much lower for passive funds. And probably this compensation won't change, and I think that incentive is given by big asset managers or even retail investors by allocating more funds to the better fund. Probably that's the incentive they would get in future in any case. But as for boutique type investors like Oguchi-san, who's here, and he managed, probably there might be another kind of incentive. Probably they got the money for the probably certain percentage of capital gains they got.
Is this point regulated? Has it been discussed by the FSA?
It's not regulated. It really depends on the arrangement between asset managers and asset owners or retail investors.
Last comment to Holger Sparmann.
Pressure is on. I have a question to all of you
about
the enforcement of these codes. And why? Because I think the problem, is very obvious. There's a free rider problem among investors. It's a collective action thing. Unlike Ron, if I understood you correctly, the active managers, yes, they have incentives to trade well, but to actually do something, it's so diluted because they only have 1% of the company. So actually engage, that incentive is fairly low. So there's a collective action problem at the very least. And the code can counter that collective action problem by basically telling everybody, well, you have to behave socially, you have to do something which will benefit all the investors. Let's not even talk about other people, but just the investors. And then the question becomes, as always, when we try to force people to do something, can we actually force them to do what we want, which is actual engagement? It doesn't have to be, I think, the level of running a hedge fund. It's just when a problem comes along, actually read the report, maybe get a consultant to understand it, and then act accordingly in your decisions. I think that's something that asset managers are equipped to do. The question is, do the codes get us that, or do they get us perfunctory compliance, which is to have, I don't know, like a nice little report at the end of the year and some expenditures that maybe push some small ones out of business, but nothing actually of substance. And the question is, based on your experience, whether you think it's one or the other.
Last round of reactions.
Shall I go first in terms of my experience? I think it is a very relevant point about active managers in terms of whether they are overweight or underweight in a particular stock. Standard Life, for example, typically it's, as it were, its index holding, it wasn't an index manager, was 2% of the UK market. That meant that in terms of the way the portfolios were constructed, however, we would typically own up to 15% of a listed company. We had various checks and balances in that particular phase. But we focused, during my term there, the governance engagement was focused on the relationship with those companies where we were overweight and significantly overweight, so that we could actually, from the interests of our clients, monitor as well as having the relationship, but monitor the governance risk, because governance for an investor is a risk as well as otherwise. The issue which you, though, put your finger on is whether when you go underweight, and institutions in the UK do not, to my knowledge, do this, but do you actually start to sort of encourage behaviors that actually would cause that particular stock to underperform, so that you arguably, in a pure way, have an incentive to do that, so that your relative performance is enhanced. But that doesn't happen in practice. There is an institutional code of responsibility, and also the directors would not attach so much weight to your views.
It's also the case that within the same fund family there will be long-short funds. So some funds will be long a stock, other funds will be short a stock. The portfolio managers themselves will make sure nobody's playing with it, because they're compensated powerfully on their own on the performance of their own fund. But what Guy suggested, which I think is really important and shouldn't get missed, is that there are the most important governance decisions in my mind that an investment manager makes is on issues that are put to the shareholders which are value related. That is, their investment decisions. Do we like these directors when there's a contest? Is the price on a takeover high enough? The first question I would ask of any investment manager is whether those decisions are being made by the portfolio managers, or are they being made by some other governance group? If the answer is the latter, then that's not a fund you want to be part of. You want those investment decisions to be made by the portfolio managers, not by anybody else. And they'll be made, and those votes will typically be made differently by different funds with different holding different portfolios within the same fund complex.
Okay, so I think we should draw to a close because we still have dinner ahead of us, and some of us are wide awake now and others are really asleep. Now, let me try to conclude. I mean, this really reminded me of the very first days of corporate governance in the 90s, when the first corporate governance codes had just come out, and we debated whether those were useful or not. I still haven't made up my mind personally today. But one thing that you can say about corporate governance codes is they have raised awareness. Every single company in the world now has a corporate governance section on the website. They have a person responsible for corporate governance. Now, maybe, at the very least, this is what these stewardship codes are going to do. They're going to raise awareness of the stewardship that, and let's not forget, Guy, that Standard Life has been an outstanding pupil, an outstanding example of stewardship for many, many years, but not all asset managers are like the firm that you used to work for. So at the very least, it's going to raise awareness, and for us, it's going to give us some voting data. So hopefully, at some GCGC conference in the future, we might see a research paper presented there on stewardship codes, and then we will have another discussion. Sorry? We always have an endogeneity problem. Okay, that was caused today by this conference. Okay, so let me thank you, Tokyo University, for this very good first day. And let me thank you, all the speakers for today and the discussants. It's been a very good day. And we still have a wonderful dinner to look forward to. Thank you very much.